So in this explainer, we're going to deconstruct a real estate partnership to really see what makes it tick. We'll dig into the financial engine, the legal framework, and the operational systems to understand how it all works together as one cohesive machine. Let's dive right in. You know, we've all heard this a million times. The conventional wisdom says that mixing your personal and professional lives, especially in a business venture, is just a recipe for disaster. It's seen as this massive risk that could blow up not just the business, but the relationship itself. But what if that assumption is all wrong? This analysis really challenges that idea head on. It suggests that when it's structured the right way, a real estate investing business can actually become a powerful accelerator for a relationship, creating this incredible shared mission that goes way beyond just separate careers and paying the bills together. Let's see how that works. Okay, so the heart of this entire model, the real secret sauce, isn't just about owning a bunch of properties. It's a very specific financial engine. And that engine is powered by a key tax advantage that completely changes the game for how you build and compound wealth over time. Now, let's get into the mechanics. It's a tax designation called Real Estate Professional Status, or RREPS for short, and the requirements are no joke. One partner has to spend over 750 hours a year and more than half of their total working time on real estate activities. So this isn't some passive weekend hobby. It is a major, major commitment. And this is where the magic really happens. Once one spouse qualifies for REPS, the partnership can use what are called paper losses, things like depreciation, to legally reduce the tax bill on their main income. This creates an incredible feedback loop. The money you save on taxes gets reinvested into more properties, which then generate more tax advantages, which fuels even more growth. It just keeps compounding. Okay, so with that financial engine humming along, a really interesting problem popped up. It was this critical trade-off between legal asset protection on one side and financial accessibility on the other. This is exactly where the theory meets the cold, hard reality of getting a deal done. So check this out. At first, the top priority was anonymity. They used this complex LLC structure to keep their personal names off the public record. Makes sense, right? But it created a ton of friction with lenders. The underwriting process dragged on, and more importantly, the interest rate they got was way higher, like 8.5%. The alternative? Closing in their personal names. That would have been a smooth process with a much better 6.5% rate. That's a huge difference in your cost of capital. And that brings us to the key insight here. Your legal structure isn't just some document in a filing cabinet for protection. It is an active financial variable. That desire for anonymity came with a real, tangible 2% premium on their loan. It just goes to show you that your legal and financial strategies have to be perfectly in sync. Now, no plan survives first contact with reality, right? Some early and very expensive challenges forced a massive evolution in how the partnership operated. So this next section is all about that critical shift in mindset, from hoping for the best to planning for the worst. You know, they started out with that classic spreadsheet optimism, assuming every deal would perform exactly as projected. And then, bam, a massive, totally unbudgeted roof replacement was needed right after closing a deal. That one costly surprise changed everything. The entire model shifted from being based on optimism to being built on a foundation of preparedness. So what did that look like in practice? Well, due diligence on major systems like the roof, HVAC, and plumbing became absolutely non-negotiable. Contracts were written with way stricter inspection contingencies, giving them the leverage to renegotiate or just walk away. Every single deal was financially stress-tested before closing, and they started building up much stronger capital reserves. It was a systematic effort to engineer the risk out of the entire investment process. Okay, so we've covered the tech strategy, the legal structure, the risk framework, but none of that stuff works without the human element. This analysis distills all that experience into a 5-point blueprint for making the relationship itself a core and incredibly resilient part of the business. So here it is, a blueprint for systemizing the partnership. First, define your roles early. Let each person play to their strengths. It cuts down on so much friction. Second, and this one is huge, you have to over-communicate. Schedule regular check-ins to make sure you're always aligned on risk and vision. Third, use real business systems. Treat it like a profession, not a hobby, and it takes a lot of the emotion out of decisions. Fourth, always play the long game. Having that shared vision helps you navigate the tough times. And finally, celebrate the growth. Not just the financial wins, but the personal and professional development too. That's what keeps the human partnership just as strong as the business one. So this all brings us to one final thought. What this entire case study shows is that a partnership, whether it's personal or professional, can be deliberately engineered for success. It's not just luck. So the question this leaves us with isn't whether to mix business and relationships, it's how are you structuring that partnership to make absolutely sure it becomes your single greatest asset.